Morning, everyone. Good to see you. Good morning. Good to see you all. What a pleasure to be here. Thanks so much for the invitation and the opportunity to stand in front of this, I think, very excellent crowd. It's already been such an interesting morning. Usually, hearing so many positive news, you almost have to go to China. But it's been very positive about China over the last a couple of sessions. But I think it's also, in many regards, very well deserved, particularly in the green space. So we mentioned a couple of times this morning the role of finance and how difficult it is potentially to finance the green transition. And so I will talk about the role of green finance and the contribution to the ideally green economy that China is building. Let me introduce myself quickly. So my name is Christoph Nedopil, and I'm the director of the Griffith Asia Institute at Griffith University. So the great state of Queensland, almost as beautiful or more beautiful than Canberra. Please come next time to Brisbane as well. I've lived in China before coming back to Australia. So I lived there for 6 years. I was at Fudan University and in Beijing. Ran two research centers on green finance in particular and green development. And the work that I'm producing or kind of sharing with you today is based on kind of our annual China Green Finance Status and Trends. So that's 2023, 2024. But for us, we updated the numbers so we can get the latest numbers. Where are we heading with green finance in China? Now, first of all, why is China potentially one of the leaders in green finance? What's the history of it? And I think there's a couple of reasons that I want to hone in. Of course, worldwide, we see kind of a lot of natural catastrophes. And so there's a clear recognition that we need to address environmental concerns, that we need to address environmental risks, as we like to say in finance, and potentially opportunities. Now, China's green finance system did not evolve around climate. It evolved actually around air pollution. So that's when we had in 2013 the apocalypse, and there was a lot of noise around reducing air pollution, particularly from coal-fired power plants. And that's why in 2015, when the green finance system was established pretty much as it is now, the focus was on clean coal rather than on carbon reduction. Nowadays, clean coal has been removed, so there has been significant progress in understanding and internationalizing green finance. So we are including the pollution control and the greenhouse gas emissions. Now, green finance also why green finance creates a massive opportunity. So this is actually from our China Green Trade Report that we published in earlier this year. And so 2020, looking at the whole 2023. And it's really this is the export of the new three. So solar, lithium, electric vehicles. We've heard about them a couple of times. I think the growth curve is quite massive, and I think we have another one. So the share of the old three and the share of the new three, really, I think that's a unique growth story that China has achieved over the last 5 years in particular. So really rapid development of these three new. And this has potentially also been made possible by steering finance in the right direction and reducing finance for the wrong things. Another reason why China is trying to lead in green finance is green soft power. So it's a concept that has been developed now more and more. I've done some studies around green soft power and the role of China's green soft power based on Belt and Road Initiative, Green Belt and Road Initiative. But China has taken a much more important leadership role in the global green finance space and of course climate space, and that is financed through green finance. There was also this year at COP29, the first time that China actually produced a number for its climate finance for developing countries. So that's a new achievement. There were a number of studies. I've been actually involved with the Chinese government, which will publish next week, which probably the numbers are also based on that were officially announced. So there's kind of a lot more green soft power that China is trying to achieve also with its green finance. So for those who don't know what green finance is, and maybe if you heard about it, just a very basic understanding. What is finance about? Finance is about making a profit. Very simple. So I always like to say investors are very simple people, not too many considerations except how do we make money. And you make money if you have more revenue than cost. That's very simple, more revenue than cost. Now the tricky part, what makes a good investor rather than a bad investor, a good investor knows how to manage risks. So these are the three components of finance: cost, revenues, and risks. Now when we talk about green finance, we add environmental considerations into this. So include environmental risks and opportunities in financial decision-making, potentially also environmental costs, of course. So this is the basics of green finance. And there's, of course, much more to it. But if you keep that in mind, understanding environmental risks just have become much more prevalent and also much better understood and researched. So how has China done it? How has China developed its green financial system from a kind of regulatory system? And I'll show you a little bit about the regulation in a second. The green financial system in China has been established actually in the early 2000s with the green credit system. China was the first country in 2012 to issue green credit guidelines. So that's for banks to issue loans and has allowed for a number of innovations in different pilot zones that are not just centralized, but there's a number of different pilot zones for China to experiment with green finance. So since 2015 in particular, we had 2 or 3 phases of green finance pilot zones in addition to the national development. Most importantly, Shanghai kind of also stepped up its game. Shanghai was last year developed the first transition finance taxonomy, and Beijing is very important, for example, for environmental rights trading. So that's Shanghai, meanwhile, has the National Carbon Exchange, so where the carbon trading takes place. One of the real successes in terms of the green finance is, of course, the green credit, again, established in 2012. Based on China's green credit system, actually, a number of international, particularly developing countries, have strengthened their green finance collaboration. And the IFC and BIRD probably was also very involved in kind of the establishment of the green financial system in China back then. It's really a remarkable growth story. And here we pulled out really the latest numbers until Q2 2024. And you see that in the latest numbers, the green credit make up 14% of the total credit market in China. That's quite remarkable. And so by now it's $4.81 trillion in green loans that have been issued. And again, these are loans from financial institutions to their commercial counterparts. And a really strong increase also over the last every quarter, it's pretty much an increase. So really a fantastic success story for financing the green economy through green loans. It's a little bit different with the green bonds. So that's obviously only the numbers until September 2024. So it's not all the way, but it doesn't look kind of as if it's a growth curve, and it probably isn't. So 2022 was the peak year of green bonds. It's still very important as a financing mechanism. I think there are some considerations, kind of why issue a green bond? Does it really lower cost? And is there not other ways of financing it cheaper? But overall, China's green bond market remains the world's largest or second largest green bond market. And it remains an important financing instrument. What's interesting in the green bond market, and this I think also shows the development of the green bond market, here we distinguish between the state-owned enterprises, central state-owned enterprise and provincial state-owned enterprises, and non-state-owned enterprises. And whereas kind of at the earlier times, 2021, non-state-owned enterprises practically did not issue green bonds. In 2023, it's already 20%. So the private sector has taken up green bonds much more than they used to, because most likely there is actually some advantages. So we did a study that in the early days of the green bond market, it was more costly for issuers to issue green bonds. So the premium was higher, so the interest rate was higher. Whereas in the later years, when the green bond market became a little bit more mature, the issuance costs were actually lower for green bonds compared to vanilla bonds. So that's quite interesting. And I think also shows about the maturity of the green bond market that has existed since 2016. Funds, kind of the equity funds, is also an important financing instrument. So we had credit, that is private between banks and companies, the bonds that is on the market, everybody can buy a green bond, and then the equity instruments. So we also saw a decrease of the new funds, so issuance number, which is not a bad thing. I think there was an absolute exuberance in 2022, 2021, and so some consolidation in that space, I think, makes it cleaner. The other reason why we see this worldwide, we see a consolidation of green funds, is because the reporting requirements are actually becoming better. And so greenwashing, just naming something green, is going to be much more difficult and potentially risky, and because you can be sued. So all the green funds that are being issued now tend to be better than they used to be because of the disclosure guidelines. We'll also talk a little bit more, I think, in the afternoon about the role of carbon markets. And carbon markets play a role to drive the economy to a greener space. My opinion is so that at this point, the carbon market design is not really good, just because it's not really a cap and trade market. And nevertheless, we saw some increase in trading volumes and also in price. I find it very humorous that China praises itself for having the largest carbon market in the world. You have the largest carbon market in China because it's the most carbon, not because the market is so strong. So the underlying asset is very big, but we want to reduce that, of course. Nevertheless, there are some important developments in the carbon market this year, particularly that carbon offsets have been re-established. So that's a good sign that China and more industries have become part of the carbon market. It's a sign that China takes the carbon market at least into consideration to steer the economy. There's a number of reasons, kind of in terms of the system support, why China is also really putting policy support into the green financial development. So we have a new green and low carbon transition industry guidance catalog. So that's a transition finance, really important. We kind of started with, this is green. Now kind of we talk about how do we transition from brown to green as well. That's an important step to really decarbonize, particularly the hard to abate sectors. How do we finance them? What is possible through financial instruments, and how do we report on this? There's a number of new disclosure guidelines. So in finance, it's very important that we disclose our environmental impacts, number one, and our risks that are caused by climate change. If you think about a bank that has a lot of real estate down at the Brisbane River floods are increasing and are increasing in severity. What does it mean for a financial institution if they have a lot of loans and mortgages in these areas? Same in Shanghai. So I always like to tell a joke and kind of make the pun in Shanghai. Everybody knows here what Shanghai means, of course. It's above the ocean. And so, of course, with climate change, at some point, it might be Xiahai, below the ocean. And then, of course, there's a huge impact on the real estate and the value of the real estate and the banks that are financing this real estate, for example. And so these disclosure policies are important to understand these financial risks from climate change and the finance emissions. I'm actually going to China tomorrow to discuss with MEE a new disclosure standard that we've been developing over the last 2 years to strengthen financial disclosure on environmental risks.
You have one.
Perfect. Now, China is also kind of, on terms of, we talked a little bit about international collaboration. Finance, green finance is one of the areas where international collaboration remains very possible, and the Chinese are very strong in collaborating from the beginning on green finance. talking to government officials, also they, during the Trump administration, saw green finance as one of the few areas where strengthened collaboration was possible. So it is very important because in the end, we all want to kind of have a strong economy while decarbonizing. Now I'm going backwards because I'm holding it the wrong way. All right. We also shared the couple of recommendations 2 weeks ago with the PBOC in Shanghai. They were polite about our recommendations. Maybe they also listened, but it was a great meeting, actually. There are some low-hanging fruits, I think, that can be addressed, and some more difficult areas that would have, nevertheless, higher impact. So every year we update this kind of opportunities for driving green finance. So establish a unified ESG disclosure standards. We currently don't have that. All the different companies have different ESG standards and make them mandatory. It's difficult, but it's possible and has a very high potential. The kind of improve ESG risk management for Chinese companies in the new 3. I think that's a relatively good one because, again, we're trying to drive up the new 3, but there is still a lot of environmental concerns. Just because they're in the green industry doesn't mean that they're green. So I think that's a big risk. Expanding carbon market and boost trade liquidity, that's important, but again, very difficult. With that, I look forward to your questions and forward to a very successful conference. Thanks so much.
Hello, good morning, everyone. I hope it's still morning, right? Good morning, everyone. I am Dr. Wang from the Research Institute for Global Value Chains, University of International Business and Economics. I would like to say a great thanks to you for the invitation. And it's a great honor of me to stand here to share some of the joint research of Professor Jinjun from the Nagoya University, as you see here, and UIB on the drivers of China's economic growth and from the perspective of global value chain reconstruction. So I'm going to talk about like 4 parts. So start with sharing some of the basic, data on the a brief historical view of China's economic development based on the data and the predictions. And then I'm going to talk about the characteristics and the impacts of the GVC reconstructions. Some of the findings are actually based on the latest working paper of the GVC Development Report 2025. We're going to publish the next year. And then I'm going to talk about the possible pathways for China to sustain economic growth. And at last, I'm going to conclude. So, because I was just told I have 15 minutes, so I'm going to be brief, but I'm happy to take questions. So to start with, we could see here on the data, so we have a basic judgment, like, China's economy ends up high, growth and moves towards low medium growth, because we could see, from the chart, the 2-digit growth rate no longer exists ever since the year 2010. And after that, we came up with a new term. We call it a new normal, as we already know, in the year 2014, which indicates China will stop its, extensive growth and going to transit to be the intensive growth mode. And after that, in the year 2018, the U.S. and China trade conflict starts. And together with the outbreak of the COVID-19 in the year 2020, actually worsened the situation for China. You already know it. And I would like to mention is, as I put it here So the U.S.-China trade war, not only, hampered the exportation of China, but also it's actually accelerated the speed of the GVC, reconstruction, which is the main, one of the main drivers will be decoupling China. So why we would like to mention here is because one of China's, drivers for its high-speed economic growth is its integration to the global value chains, according to a lot of, research. But when the, great, we call it the great, GVC reconstruction starts, are there any opportunities for China in the future? Because, as you can see here, the IMF forecasts a continued decline in China's economic growth, in the coming years. So there's a lot of hot debate, like, are there going to be any opportunities for China in the future? So I put a very hot, debated, topic, like, are there going to be a V shape in China's future? That means China will rebound very soon. or maybe a L shape. That means this, medium and even low, speed of economic growth will continue for quite a long time. So before we jump into any conclusions, because we see a lot of challenge here, so I would like to show you some of the evidence, like, maybe there's more opportunities in the future for China. One of them is, although we emphasize the role of exportation for China, especially for China's economic drivers, but if you're looking at the data, we find actually China's GDP is actually less and less depend on export, less and less depend on the export. And if you're looking at the results of the decomposition of GDP growth contribution rate, and the net export actually not as important as the other two drivers in China for China's economic, development. So, and another very important issues I would like to mention is, although we talk a lot about the GVC reconstructions ever since the year 2018, but if you're looking at the GVC network we created based on the intermediate goods, transfer, we could see actually China still play the major part in the global production network. And as you can see here, we call it 3 factories in the world. That is factory Europe, factory, Asia, and factory North America. So we could see China still play the major part in the, Asia region. So China is some sort like a bridge. It connects not only the developing economies, but also the developed economies. And also China is a very important intermediate goods producer for United States. So this is, although we talk about, sorry. Yeah. So China is still playing a very important role, as you can see here, in the regional and also the global value chain network. So why, we're going to talk about why, we start to talk about, decoupling China. So why China becomes, certainly becomes a target of the developed economies and also developing economies in, the decoupling. So that's one of the reasons here, shows in a table that shows like, how the country's interdependence on its global, production activities. Because we know nowadays, countries, no longer like before, we produce everything in our own country. So nowadays we produce like a production team. So just like the Apple product in China, we are the biggest, the largest, assembler of Apple products. We import intermediate goods from the other countries like Korea, like Japan, like Germany. So this is how we depend on each other. So how about China's role in this interdependence network? We could see here the red column here. It shows China not only very important, intermediate goods producers for Asia factory, but also produce a lot of intermediate goods for, European and North America as well. So there's a lot of countries, they feel the risk, they depend so much on China, especially from the perspective of intermediate goods. So they started to worry about, their GVC resilience because it depends so much on China. So that's one of the reasons they would like to decoupling China. And another point here is, as we mentioned before, the China and the US trade conflict, it actually, sending signals to the other countries, especially as we say, as the friends of the United States. They're trying to, nearshoring or reassuring their production activities. Because before, like in the year 1990s, a lot of multinational enterprises, they actually outsourcing the production activities to China. And nowadays, instead of, offshoring the productivities to China, they're trying to reassuring back to United States or Japan, to fight with the industrial, what we call it hollowing out, in the era of global value chains. And also they're trying to reassuring the production, activity to the friends, for example, like Vietnam or Indonesia. So we see a lot of new trend here in the global, value chains reconstruction. And also, yes, there's a lot of countries trying to decoupling China, but is that easy to decoupling China? So based on the intermediate good trade data, we can see, especially compared with the year 2018, the blue bar, and the 2022, the red bar, you can see, although countries are starting to trying to decouple China, but only like we could see United States and Japan actually, is really decoupling China. Because, as you could see, they use less and less intermediate goods from China in their production. But for the other countries, as you can see here,
not only developed economies like Germany, UK, but also developed economies like, India, Mexico, they actually use more and more intermediate goods from China. So it's not that easy to decoupling China in global value chains. And another point here is, as we already showed you, United States leads the campaign of decoupling China. So we have more evidence to show you, instead of import from China, they started import from like Vietnam or Indonesia or, Chinese Taipei instead, and Mexico. And another important, issues we'd like to mention here is the dropping off of the FDI inward FDI to China. So, and also I believe we already see a lot of news, like, a lot of FDIs are actually moving out of China. So there's a lot of challenge in front of us. So what do we do in front of all these challenges? Can we maintain the economic growth in the future? So this shows some of the pathways for China to sustain its growth. One of the findings of our papers is actually, although the direct export from China to United States has declined, but we find, what we call the third country or the third economy's exportation is actually increasing. That means, the indirect import from China to United States actually increased because, all of these three conflicts between China and the United States. So China, instead of export directly to United States, they started to indirectly export to United States through, for example, here like Mexico and Vietnam. So that means like Vietnam, they import the intermediate goods from China and then export to the other countries, especially the United States. So this, although, the direct, the GVC connections between China and the United States has been weakened, but the indirect GVC connections are actually getting stronger and stronger. So this is one of the phenomena we see, through the US's friends, economies, China's indirect, exportations are actually increasing. And another point here is, besides, the indirect export channels, China actually, started to, increase investment to the third countries, especially, in Vietnam. And this data shows you, like, Chinese enterprises invest in Vietnam and started to build the factories there and to facilitate their export to United States. And this is the top 10 Chinese electronic components assembly companies' activities in Vietnam. So as you already know, like BYD, like Foxconn, they all started to invest in Vietnam instead of, in China, and trying to facilitate the exportation from China to the United States. And another point I want to address here is, although the inward FDI to China is dropping, but we could see another very important, phenomenon here is through China's outward FDI, actually it can boost China's economic growth. So we have a lot of, evidence shows like, when China invests to United States, United Kingdom, Germany, and all these developed economies, actually it can boost China's economic development through what we call the reverse technology spillover effect. So this is another strong evidence to show you, through the outward FDI, China can also boost its economy. And of course, we're going to have mentioned here is the news 3, as a lot of speakers already mentioned before. So like, the export of PV and EV and the batteries. So it actually becomes the new drivers of China's exportation. And so they already showed, I'm going to skip that. So at the last, so not the least, we're going to emphasize is the EV, the role of EV, because we talk a lot about electronic vehicles. And from our perspective, we're now working on input-output data that can distinguish the EV industry with OECD and IDGETL. We're trying to figure out, what is the real role of EV can play in these industrial organizations. And we already find evidence, like, not like the traditional, inner combustion engine vehicles. EV actually created more job opportunities and also boost more technological innovation. And we can see a lot of new phenomena nowadays in China, like Huawei and Xiaomi, who used to be the phone maker, but now they actually producing the EVs in China. So it's actually new opportunities for different kind of industries to integration together. So this is one of the very interesting phenomena that can only happen in EV. This is kind of new technology and industry here. So, and also we doing a sort of research to see what is the, the opportunities for inclusive EV supply chain. Because when we're talking about EV, we talk about China because somehow China dominates the downstream of the EV supply chain. But according to our research, actually, the whole EV supply chains is very inclusive. It will include more, developing economies into this, the EV supply chains, and will create more job opportunities. And of course, for the EV, the major market of EV are actually from the developed economies instead of the developed economies. And not to mention like that, most of the raw materials of EV, like the rare earths, yes, and are also actually comes from the developing economies. So based on our research in the future, EV actually can be more inclusive for the developing economies and these whole global supply chains. So to conclude, yes, we know there's a lot of challenges, especially in front of the GVC reconstructions. We're decoupling. We have a lot of trade barriers. But we still have strong faith in China's economic, growth, especially, from what we call the new drivers, like the new technologies and what we call the new productive force. And also, I would like to echo today's saying that the great energy transition, I think the green energy transition in China also brings more and more job opportunities, like the EV, like the PV, and also, it boosts the technological innovation. And also, we believe this kind of new drivers, especially the transition from the what we call the black economy to the green economy, will definitely become the new stimulus for for China's economy in the future. So that's everything I would like to mention today. And I have more pictures of the the GVC reconstructions. If you're happy to know that from the different kind of industries, I'm happy to take questions afterwards. Thank you.
Good morning, everyone. Great pleasure to be part of this event. My name is Liu. I'm a senior lecturer in the corporate school. So I'm going to talk about China's economic growth, national savings, and external balances. So everybody in this room knows that China has experienced remarkable economic growth over the last several decades. And this rapid economic growth was coupled with some really high national saving rates and persistent trade surpluses. So this high saving rates and large trade surplus indicates over a long time period indicate that there are strong internal and external imbalances of the Chinese economy. So I'm going to argue that this macroeconomic imbalances are the main barriers for the future sustained economic growth. And also argue as a side point, the development, the booming of this green technology industry won't be able to deal with the current economic challenges. All right, let's start with the economic challenges after COVID. So China abolished this net zero or the zero COVID policy in December 2022. So in the following 2 years, 2023 and 2024, we have observed weaker economic growth, weaker consumption, weaker investment, together with higher public debt and stronger geopolitical tensions with advanced economies. The government has responded with a set of macro policies, particularly the government increased spending on public infrastructure, reduce taxes, and a set of expansionary monetary policy, together with industrial policies that support green technology industries. Despite the strong macro policies, the GDP growth remained weak relative to China's long-term economic performance. So this is the GDP growth, quarterly GDP growth since 2023. And if you look at this, the numbers, this is the growth rates in the first 3 quarters of this year. So this seems to suggest that these macro policies were not very effective, even in the short run. And also in the long run, the macro policies are not sustainable in the long run because China's public debt is already really high. And more general, macro policies by nature, they are not suitable solutions for long-term problems. So what I'm going to argue is that these economic challenges after COVID are not short-term problems, but are long-term structural problems. And these long-term structural problems include two dimensions. One is the internal imbalances, which are characterized by high saving rates and low consumption rates. And the other dimension, the other problem is the external imbalances, which are reflected by large current account surplus over a long time period. Okay, now let's look at the Chinese economy from a long-term perspective. So this is GDP growth since 1980. So we had a remarkable economic growth over the first several decades. And if you look at the time period after the global financial crisis, the GDP growth was already on declining trend and reached at 6% before COVID. This is remarkable. The problem is that this rapid economic growth was not fully translated to consumption. Why do we care about it? Consumption? Consumption is the metric for welfare. Now let's look at the consumption. So this line is the consumption, China's consumption, measured as the percentage of GDP. And you can see that consumption continues decline from 1980 to 2010, and then moderately increased in the 2010s, and then declined again after COVID. This line represents consumption in the United States. Over this long time period, the consumption in the United States remained about 80% of GDP. And all other advanced economies also have similar levels of consumption of GDP. And you can see there's a big gap here, right, over the long time period. So when we say consumption become weaker in the last several years, indeed, this is true, right? Indeed, it's true. But I'm going to argue that consumption in China was always weak, and for a long time. So this is a long-term problem, not a short-term problem. So if we break this aggregate consumption into private and public components, so this is private consumption, and this is public consumption. So private consumption continues decreased to 2010, and it slightly increased in the last decade. So this is public consumption remain relatively stable and slightly increased in the last decade. That's consumption. And then let's look at savings. So savings are just a mirror image of consumption. When consumption was low, savings were high. And the saving rates were really high. So if it was about 40% and even 50% in the last 2 decades, much higher than the United States at the benchmark here. So United States saving rates roughly remain at 20% steadily over time. So there are a number of reasons for China's low consumption and high savings. The first one is the Chinese government always prioritizes investment in exports over consumption. The second one is underdeveloped social welfare systems, particularly in relation to the ecosystem. The third one is increasing cost of essential services, including housing, education, and healthcare. Basically, you just need to save a lot of resources and to purchase these basic services. And the fourth one is China faces a rapidly aging population due to the previous one-child policy. And also related to the aging population, China's pension system, which is a part of this social welfare system, is not well developed either. So this also people increase saving to finance their retirement consumption. And the last one is also increasing wealth inequality, which suppressed consumption because rich people tended to have lower marginal propensity to consume than poor people. That's the consumption and savings. Now let's look at the investment. So this is the investment as a percentage of GDP for China. Over the first several decades, this investment increased very fast, which is what we would expect from a fast-growing economy. And then investment remained stable, and then start decline in the last decade. And also, in comparison with the United States, it's the United States. So China's investment is much higher than the United States. If we break this aggregate investment into two components, this is private investment, and this is public investment. Private investment started to decline in the last decade. Public investment has been continuously increased over time. This is because Chinese government was always in favor of this public spending on infrastructure investments. Okay, let's put savings and investment together. So this line is savings, and this line is investment. So China's investment was high over the last several decades compared to advanced economies, but savings were even higher. And the gap between savings and investment is the current account balances. If you're not familiar with the current account balance, it is mainly the trade balance. So this is the current account balance. Again, it's a gap between national saving and investment. So this is zero line here. So most of the time over the last several decades, China has a current account surplus. Particularly, this current account surplus increased very fast, increased sharply after China joined the WTO, and then dropped dramatically after the global financial crisis. In the last decade, China still has persistent current account surpluses, and also bounced back after COVID. This is just exports and imports separately. So most of the time, exports were always higher than imports. What is interesting here, if we look at the after COVID period, this exports increased very fast. This is because exports of current technology products increased. And this helped to boost economic growth through international trade. But I'm going to say that this is good from a trade perspective, but this won't able to address macroeconomic imbalances in the Chinese economy. So there are a number of reasons for current account surpluses, persistent surpluses over a long time. The first one is China's increasing trade and increasing openness and integration into the global economy, particularly after the WTO. The second reason is this really high saving rates due to low consumption. And the third one is related to investment. China's financial system was mainly state-dominated. So this state-dominated financial system were not efficient to channel savings into private investment. So this additional resources must go overseas, which contributed to current account surplus. And also another reason is that China's manufacturing products were highly competitive because due to low labor cost, and which facilitated international trade, international exports. And also China's the government always promoted this exports through different policies. For example, subsidized exports, providing tax credits for exports, and also the central bank manipulated this exchange rate, so which would facilitate exports. To conclude, so China's high saving rates and persistent trade surplus reflect its low domestic consumption. And this rapid economic growth is not fully translated to consumption, which is the measure for welfare. So this is bad. And this Long-term internal and external imbalances are primarily attributable to policy, institutional, and structural distortions. So this conclusion not only from this observing this long-term pattern of key variables, but also based on a number of studies in the literature. And in response to the current economic challenges, macroeconomic policies became less effective, even in the short run, and are not sustainable in the long run. And as a general principle, long-term economic growth must be consumption-driven, just like in all these advanced economies. And this long-term economic growth should contribute to consumption-based welfare. In terms of the policy implications, I would argue that annual reforms should aim to reduce structural distortions, integrate the mainstream markets, improve social welfare systems, and eventually increase household incomes. So this can boost the private consumption. I'll stop here. Thank you.
We don't have much time left. Probably I will have 3 questions, probably. Okay, anybody want to ask questions? Oh, there.
Dr. Christoph, I was wondering about green bonds. So it sounds like green bonds, they're getting kind of the system's getting more efficient, getting less cheaper, but they're still like talking about state-owned enterprises. You kind of see green bonds as kind of a part of China's industrial policy supporting, and we can kind of see industrial policy supporting green economies around the world. But is that like how big of a kind of, or do you consider that kind of industrial policy that's supporting kind of the green economy in China?
Absolutely. I think any green policy that we have all around the world is an industrial policy. So of course China is also embarking on that very consciously. The reason why state-owned enterprises went for it, because their incentive system is slightly different than for the private sector. The state-owned enterprises, it's a political legitimacy that they are also buying for issuing green bonds, because the Chinese political party, Communist Party, clearly said we want to grow the green bond market. And the state-owned enterprises feel responsible for fulfill this. And so it's, I think, not only industrial policy why we saw the growth of the green bond market, but also political legitimacy, political support in their careers and but any country, green finance is an industrial policy to drive down the climate risks and improve the economic opportunities through the green transition.
Ross, and then there.
I'd like to ask Larry, what's wrong with China saving more than it invests and financing the green transition in the developing world with large exports of capital to support investment in the new industries and the new energy through the developing world? That's the way the world economy grew in the 3 decades before the First World War. Britain saved much more than it invested, and it funded the development of the United States, Latin America, Australia, and many other countries. Now we face a period ahead in the world macroeconomy where the US is soaking up a lot of the world's savings. This year's deficit, 2% of global incomes, just to fund the US federal deficit. Trump has promised to soak up even more. Capital will be scarce in the world. What's wrong with China saving more than invests and investing in the rest of the world?
Okay.
Thanks, Ross. So I guess it just my argument is from the perspective of consumption and welfare. So for the initial stage of economic growth and development, okay, it's okay for household private sector to collect a lot of savings. This help to finance investments and also to accumulate this trade surplus and also foreign reserve, very, very important. But at this stage, now China and also Asian countries aim to move from the middle income status to the high income status. I think consumption is very, very important component contribution to GDP growth. And also GDP growth, eventually it should contribute to the consumption improvement. This is my point. And then if you put this China's trade surplus or current account surplus into the global context, China's current account surplus is just part of this global current account imbalance. So after the global imbalance have been persistent for a long time, since 1990s, and the United States is a big part of that. The United States have persistent large current account deficit, and China is on the other side. And this is also after the global financial crisis, there's a lot of policy and academic debate about this, the causes and the consequences of global imbalances. And also this is the progress of trade wars between China and this United States and also Europe and also Australia. So this is one cost of this trade surplus. And also from China's perspective, okay, China accumulated a lot of foreign reserves, and then you can only invest in the foreign reserves in the U.S. government bonds. It's just very low returns of rate of returns. It's not good for the Chinese economy either. So, and it's long-term persistent trade surplus indicate this structural distortions in this economy.
All right, let's move on.
Sorry, I am going to follow up also now. We think alike, but one question for Chris is, you want to finance all of this stuff abroad. What should China do to increase its green finance exports to other countries? Sorry, I just want to make one remark on the savings and investment, because first of all, I think it results from China's leadership not just having private consumption in their welfare function. I think there is national strength. But second, half of those national savings, they come from enterprises. The retained earnings from enterprises, which, in my view, but I'd like to hear your view, Larry, is a much easier tool to address. I.e., you simply force them to pay dividends and use it, say, for building up a social welfare system. That can be a very immediate way of reducing savings in companies, and therefore also to invest less, and they should invest less because the returns are not good. So I'd like the other direction.
Right. So kind of, I think the question was kind of how can China use green finance also to finance abroad? I think good question. China's kind of over the last years, China has, particularly through the Belt and Road Initiative, actually done a lot of green investments abroad and increased the share of green investments. So every year we write the Green GRI or the GRI investment report. So we're tracking the financing of China, and the share of green energy investments has increased. Last year was 2023 was the highest number ever. Overall, far too little in terms of Chinese financing. It has not replaced coal investments that peaked in 2016, 2017. We have not seen the same levels of green energy investments, in particular as compared to brown investments. So I think there's a long way to go and a lot of activities for China. So it was also interesting, by the way, the outcomes of COP29, where the emerging economies, that includes China in this case, are invited to contribute to the climate finance goal. And China has been identified actually as one of the already large funders of climate finance. That's, I think, much more needs to be done. Policies have changed in this regard quite a bit for China. So China has much stricter and clearer policies for what is considered green, also for its overseas investments. And so 2020 was the year that China labeled, for example, provided a labeling system, what's called a traffic light system. What are green projects for its BRI, what are yellow projects that are
group of embedded projects that are restricted included already back then.
So you want to answer the second half of the question?
What is the second half of the question?
The saving mostly was from the enterprises.
About half of domestic savings are enterprise savings.
So that's the problem.
So what can the government do there?
So more specifically, this half savings probably, the majority of the savings probably comes from state-owned enterprises. If I'm wrong, correct me. So I think there's some discussion in that. Okay, the government just need to force this state-owned enterprise to pay the dividend or pay this profits into the government and to support the social welfare system, which I agree. So that might be a good way to balance this to balance the social welfare, the undeveloped social welfare system and the social state-owned enterprises the same.
All right, I think we're over time, so let's just finish here and we'll move on.